What is DTI and why should it matter to me? Prior to the housing market crash in 2008, you used to be able to buy a home with what's called a stated income loan. You would simply tell the bank what you earned and the bank took you at your word. Your application didn't have to be backed up with any pay stubs or bank statements. So of course, everyone was getting a mortgage, but they weren't necessarily able to keep up with the payments because they overstated their income. So then of course, the market crashed. Today, more regulations are in place to ensure that kind of crash is far less likely to happen. Buyers now have to qualify for their mortgages. Different lenders have different requirements, but most lenders are going to look at the applicant's debt-to-income ratio, or DTI. According to those banks, an acceptable debt-to-income ratio is anywhere between 40% to 45%. Debts can include things like car payments, student loan debt, credit card debt, or other lines of credit. The higher your existing debt is, the less the bank is going to lend you because you're not going to overburden you at the cost of you being able to pay your bills. So for example, if you bring home $8,000 a month in gross pay and you are debt-free, the bank will allow you to have a mortgage payment of up to around $3,500 or $4,000 a month. Not bad. Now let's say you bring home $8,000 a month in gross pay, but you have a debt totaling 20% of your gross annual income. The bank is only going to give you a mortgage of about $2,000 a month because your mortgage and your other debts combined can only total a debt-to-income ratio of around 40 to 45%. So the takeaway, the lower the DTI you have, the more you can be approved for by your mortgage lender, and the better the house and the investment you can secure.